Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Immunitybio.
If you find our talks useful, please consider subscribe, like, and comment underneath. And, imagine inventing a security system so incredibly advanced that it basically makes all existing alarms look like children's toys.
Right, a total game changer.
Exactly. You bring it to market, the medical community is just astounded, your revenue starts flowing in, and your reward. You lose a fifth of your company's value in a single afternoon.
Yeah, that's rough.
It's wild. That is exactly the whiplash scenario we are dissecting today. We've gathered this massive stack of research. We're talking clinical trial readouts, FDA correspondence, institutional flow data.
The works, yeah.
Right. To really unpack one of the most volatile setups currently on the market, we're looking at a stock that was sitting on a staggering year-to-date gain of over 300%.
Which is an absolute monster run.
It is. Until this brutal 21% single-day crash on March 24th.
Yeah, it's the absolute definition of extreme volatility. Because when you see a stock gap down that violently, it forces a binary decision for anyone managing a portfolio.
Right.
You're either looking at a fundamental structural failure or you're looking at a profound mispricing.
Okay, so for anyone listening with their finger hovering over the buy button right now, you really have to ask yourself, are you staring at a terrifying falling knife that will just slice your portfolio to ribbons?
Yeah, the worst case scenario.
Exactly. Or are we looking at a classic high-reward bear trap, like a massive overreaction setting up an aggressive 3 to 6 month swing trade?
And to answer that, we really have to strip away the emotion of that 21% drop.
Because it's easy to panic.
Oh, absolutely.
Yeah.
But a stock doesn't just accidentally run up 300% in a vacuum before a crash. There's a fundamental engine driving that valuation.
Yeah.
So before we even touch the panic of March 24th, we need to understand the underlying asset here, like what is actually generating the cash, and why does the medical community consider it a genuine paradigm shift?
Let's start right there. Because this company, they aren't just a whiteboard concept anymore.
No, not at all.
For a long time, they were your classic pre-revenue biotech story, right? Burning through mountains of cash on research and development, selling investors on a dream.
The standard biotech playbook.
Right. But they've recently crossed this massive fundamental threshold. They transitioned into a commercial stage powerhouse. They actually reported $82.6 million in annual revenue.
Which is huge. That is the ultimate inflection point for an emerging biotech. Crossing that chasm from, we have a brilliant scientific theory to we have a commercial product generating tens of millions of dollars.
It makes it real.
Exactly. It validates the entire enterprise.
Yeah.
And that entire revenue stream is anchored by their flagship therapeutic, ANKTIVA. It's what's known as an IL-15 superagonist.
Okay, IL-15 superagonist. That sounds incredibly impressive. It sounds a little like a sci-fi weapon, actually.
It kind of acts like one, honestly.
Well, let's break down how this actually operates inside a human patient. Because my understanding is that this is fundamentally different from what we typically see in standard cancer treatments, right? Like targeted therapies or standard checkpoint inhibitors.
It is entirely different. To really understand the protective moat this company has built around its business, you have to understand the biological mechanism.
Okay, walk us through it.
So, standard checkpoint inhibitors, which have been the superstars of oncology for the last decade, they essentially work by taking the brakes off the immune system.
Taking the brakes off.
Right, because cancer is very good at hiding. It puts these chemical brakes on your immune cells so they don't attack.
Sneaky.
Very. So checkpoint inhibitors come in and remove those brakes. But ANKTIVA goes a massive step further. It doesn't just remove the brakes, it actively presses the gas pedal.
No.
Yeah, it stimulates the body's innate immune system. Specifically, it supercharges natural killer cells and memory T cells.
Okay, I want to visualize this for the listener because the mechanics here are fascinating. If standard targeted therapy is like, say, sending in a team of highly trained specialist snipers to take out specific cancer cells.
Which works, but it's localized.
Right. And if the cancer mutates and moves, those snipers lose their target.
Exactly.
What ANKTIVA is doing is completely different. It's like taking the body's entire early warning security system and upgrading it into this fully armed, hyper-alert defensive grid.
That's a really great baseline. But the inclusion of those memory T cells is what makes your grid analogy truly accurate.
Okay, explain that. How do the memory T cells fit into the security grid?
Think of the memory T cells as distributing a high-resolution photo of the enemy to every civilian, every police officer, and every security camera in the entire city.
Oh, that's brilliant.
Once ANKTIVA activates that system, the cancer can never hide again, even years down the line. It creates a long-term, durable immune response.
So you aren't just fighting the tumor today. You are immunizing the body against its return.
Precisely. You're weaponizing the body's own infrastructure.
That is incredible. And global regulatory bodies aren't just viewing this as an interesting science experiment. ANKTIVA has officially achieved world's first status.
A massive milestone.
Yeah, it's the first regulatory approved IL-15 therapeutic in lung cancer. And it specifically gained that approval in Saudi Arabia.
And we really cannot understate the financial value of a world's first.
Oh, definitely not.
Because first-mover advantage in the biotech sector is everything. It creates incredibly high barriers to entry. If a competitor wants to develop a similar pathway now, they are years behind and billions of dollars short.
Right.
But the lung cancer approval is really just the beginning. The real focus right now is its approval for non-muscle invasive bladder cancer.
Okay, let's translate that acronym for everyone, NMIBC. This is where the clinical trial data really starts to flex its muscles, right? Specifically, the Quality 2.005 trial. What exactly is this trial proving?
What's fascinating about the QUILT trial is the sheer statistical power they've demonstrated against the establishment.
The establishment being the current treatment.
Yeah. For decades, the standard of care for this type of bladder cancer has been BCG.
Bacillus calmette-guerin.
Right. It's an older immunotherapy that urologists have relied on forever. It is the default. And the QUILT trial was designed to directly challenge that default.
Head-to-head.
Head-to-head. And it is actively demonstrating statistically powered superiority against BCG.
So they aren't just trying to be a backup option, like if the standard treatment fails?
No, not at all.
The data suggests they're actively positioning themselves to completely replace the standard of care.
Exactly. And when a new drug beats the legacy standard of care, it doesn't just take a slice of the market share, it consumes the entire market.
Okay, so if the science is that bulletproof, if we have $82 million in real revenue, a world's first defensive grid mechanism, and trial data actively beating the decades-old standard of care.
It looks perfect on paper.
Right. Then the events of March 24th make absolutely zero sense on the surface. Why on earth did the stock violently plummet over 21% in a single trading session?
Well, the catalyst for the crash was a single headline crossing the wires. A warning letter from the FDA.
Okay, stop right there. Let me push back hard on this.
Sure.
Because an FDA warning letter is the ultimate bogeyman for biotech investors. When you hold a biotech stock and you hear FDA warning, your immediate assumption is that the drug doesn't work, the clinical trials were botched, or worse, patients are experiencing severe adverse side effects.
Completely natural reaction.
Right. So how can we just brush this off? How is this not a massive glowing red flag for the actual science?
That is the exact skepticism you have to apply. And it's exactly why algorithmic trading programs instantly dump the stock.
They just read the headline and sold.
Exactly. But when you look past the headline and actually read the text of the FDA correspondence, the nuance changes the entire narrative.
Okay, what does the letter actually say?
The letter specifically targets false and misleading promotional materials. It is a marketing violation.
Wait, but marketing doesn't happen in a vacuum.
Yeah.
If a company is willing to stretch the truth or be sloppy on a glossy brochure, why shouldn't I assume they stretch the truth on the trial data? Like, sloppy marketing implies sloppy management. Why should I trust the science if I can't trust the sales pitch?
And that is a completely valid investor concern. But here's how you separate the two. You have to look at who is doing the vetting.
Okay.
The marketing materials are generated by an internal commercial team trying to drive sales. They got overzealous, absolutely, and it is a major governance issue that management has to fix immediately.
Right, a slap on the wrist for the sales guys.
Exactly. However, the clinical data, the actual science, was not vetted by the marketing team. It was vetted by independent review boards, it was published in peer-reviewed medical journals, and scrutinized by international regulatory bodies who granted those world's first approvals.
Ah, I see the distinction.
Yeah. The FDA's letter does not state the trial data is flawed. It doesn't question the drug's safety profile. It basically just says the sales team overstepped their bounds in how they were advertising it.
So it's an operational misstep. A severe one, but not a clinical death blow.
Precisely. But, the stock market is a reactionary machine. The words FDA warning hit the news feeds, and panic selling ensues.
Let's break down the technical chart action on that specific day then. because this is where the wealth-building strategy really crystallizes for the listener.
It is.
Despite that violent 21% drop on March 24th, if you zoom out, the long-term uptrend for the year remains structurally intact.
It does. It didn't break the macro trend at all. And if you analyze the trading volume on the day of that crash, it tells this fascinating story of wealth transfer.
Really? What did the volume look like?
The stock appeared on the most active lists across the major exchanges. The volume was just absolutely staggering.
Which signals a classic shakeout.
Exactly.
For anyone unfamiliar, what exactly does a shakeout look like in the order books?
So a shakeout happens when weak hands, usually retail traders who don't have the time or resources to read the actual FDA letter, they panic.
They see the red.
Yeah. They see the headline, they see the massive red candle on the chart, and they dump their shares at the market price just to stop the bleeding.
But here's the secret to market mechanics, right? For a stock to have that much massive volume and not drop straight to zero, there has to be a buyer for every single panicked seller.
Spot on.
And who is standing there with a catcher's mitt catching all those dumped shares?
Institutional smart money.
Of course.
While retail is panicking over a marketing compliance letter, institutional investors who actually understand the clinical data and the separation of marketing from science, they are quietly accumulating the stock at a 20% discount.
Wow.
This dynamic is exactly what sets up a bear trap. Short sellers pile in thinking the sky is falling, retail runs for the exits, but the underlying fundamental thesis of the drug remains completely sound.
So when the dust settles, the price violently snaps back up, trapping the bears.
You got it.
I love that breakdown. But, to be completely objective, we also have to look at the financial reality of this company, because it's not all sunshine and institutional accumulation here.
No, biotech rarely is.
Right. Even with that $82 million in revenue, they are still reporting an annual net loss of $351 million.
It's a heavy burn rate.
And plus, they are trading at a price-to-sales ratio of 73.3. Let's translate that PS ratio for the listener. A normal, healthy, mature company might trade at 2 or 3 times its sales.
Right, something grounded.
Trading at 73 times sales means the market is pricing this stock as if it has already conquered the medical world. It is priced for absolute perfection, isn't it?
It is an incredibly rich valuation, and it really highlights the central tension of high-growth biotech. It is a cash-hungry operation.
Absolutely.
The research, the development, and the commercialization spend required to launch a drug globally is just astronomical. That $351 million net loss is a glaring warning light. It means their cash runway is tight.
Meaning, if this stock doesn't bounce, if that bear trap doesn't spring shut and the stock just languishes, there is a very real risk of shareholder dilution.
Yes, very real.
They will inevitably need more capital to keep the lights on, which means issuing new shares and diluting the value of everyone currently holding the stock.
Exactly. A PS ratio of over 73 leaves absolutely no room for error. The race is officially on.
The clock is ticking.
Yeah. They need the sales of ANKTIVA to accelerate exponentially to mitigate that cash burn before they are forced to dilute.
Which transitions us perfectly to the next vital question. Since the cash burn is terrifying, they need revenue fast.
Very fast.
But if the U.S. FDA is currently slapping their wrists and slowing them down over marketing materials, where exactly is the institutional money expecting this massive exponential future growth to come from?
They're looking at the global map.
Right.
The growth horizon isn't just domestic anymore. It relies heavily on international expansion.
Right.
And the prime example of this is Macau.
Yes, let's talk about Macau. Because Immunitybio just secured regulatory approval there. And the mechanism they used to get it brings up a concept I find incredibly fascinating, the reliance-based review pathway.
This is a seismic shift in global biotech strategy.
Really? How so?
Well, historically, the regulatory landscape was highly fragmented. To get a drug approved in a new country, you basically had to start from scratch. You had to run new, localized clinical trials on their population, navigate their specific bureaucracy. It can take a decade and cost hundreds of millions of dollars per country.
They're a massive bottleneck.
Huge. But a reliance-based review changes the game entirely. It allows a regulatory agency in one country to look at the audited clinical trial data and approvals already granted by a trusted, rigorous regulatory body in another country.
And they just say, hey, we trust their homework.
Exactly. We trust their homework.
So it is essentially a regulatory fast pass. It's a way to skip the line and start generating actual flowing revenue in emerging Asian and Middle Eastern markets without having to repeat 10 years of grueling trials from the ground up.
That is exactly what it is. Macau looked at the data, recognized the validity of the underlying science, and granted approval based on reliance.
That's huge for their revenue timeline.
It really is. It opens up a rapid, highly lucrative route to commercialization in global markets that completely bypasses the traditional U.S. bottlenecks.
And it isn't just Macau utilizing this. We are seeing deep strategic engagement with regulators in Saudi Arabia, too.
Right.
We already mentioned the world's first lung cancer approval there, but there is also a lot of institutional chatter about a broader U.S.-Saudi biotech alliance.
Yeah, and when you connect those dots, it signals something much larger than just one single drug approval.
What does it signal?
It implies deep-seated geopolitical backing. Saudi Arabia is actively, aggressively trying to diversify its economy away from oil.
Right, Vision 2030 and all that.
Exactly. They want to become a global hub for biotechnology and advanced medicine. By partnering with companies like Immunitybio, Saudi Arabia gets cutting-edge, world-first therapeutics for its population.
And Immunitybio gets an incredibly well-funded, highly motivated market to launch their products and generate cash flow rapidly.
Precisely. And that geopolitical backing feeds directly into the speculative chatter swirling around the stock right now.
The buyout rumors.
Exactly. Because in the biotech sector, when you hold a world's first approval for a novel mechanism like an IL-15 superagonist, you instantly become a target.
You become the prettiest girl at the dance for the massive legacy pharmaceutical companies.
Basically, yeah.
The buyout speculation here makes total sense, really. Because if you are big pharma, why would you spend 10 years and $2 billion trying to invent your own defensive grid immune therapy when you can just buy the company that already built one, proved it works, and got it globally approved?
You wouldn't. It's that simple. Big Pharma has mountains of cash on their balance sheets, but they are constantly facing patent cliffs where their old drugs lose exclusivity.
Right, they need new revenue streams.
Desperately. They want to enter or expand their footprint in the highly lucrative immuno-oncology space. Buying a company like Immunitybio instantly de-risks their innovation process.
It's a plug-and-play acquisition.
Yeah. Now, that is purely speculative, obviously. You never buy a stock solely hoping for a buyout.
No, that's dangerous.
But it is a massive fundamental floor. It's why institutional money steps in so aggressively during a 21% dip. The underlying asset is simply too valuable to ignore.
All right, we have mapped out the entire battlefield here. We've talked about the terrifying cash burn, the nuance of the FDA marketing letter, and the shakeout mechanics.
We covered a lot of ground.
And we've mapped the global upside, too. The fast-pass approvals, the geopolitical alliances, and the buyout speculation. Now, let's get down to the actionable wealth-building takeaways.
Let's do it.
For the listener looking at their portfolio today, what are the exact near-term dates and events they need to monitor to capitalize on this setup?
So the catalyst calendar over the next 3 months is incredibly dense. It requires close attention. First and foremost, there is a very specific, unforgiving clock ticking.
Mid-April 2026.
Correct. The FDA response deadline. When you receive a warning letter like that, the FDA gives you exactly 15 working days to formally respond.
Just 15 days.
Yeah. The company must submit documentation proving they've updated their marketing compliance, pulled the offending materials, and trained their staff.
Okay, and a satisfactory comprehensive response instantly removes that immediate regulatory overhang.
Exactly. Which, if you were trading this, could be the exact catalyst required to snap that bear trap shut and send the stock violently rebounding back to its previous highs.
Wow.
That is the immediate hurdle. Once they clear that, we look to the major regulatory filings. On March 18, 2026, they resubmitted the sBLA for papillary bladder cancer.
And let's translate sBLA really quickly for everyone. That's a supplemental biologics license application.
Right.
Essentially, it's the massive stack of regulatory paperwork you file when you want to expand what an already approved drug is legally allowed to treat.
Exactly right.
They want to add a specific type of bladder cancer to the menu to expand their addressable market.
Yep. That sBLA is actively in the pipeline right now. And alongside that, we have the upcoming final analysis and submission for the BCG, naive, and MIBC indication later in 2026.
Which, as we discussed earlier, is the trial data showing absolute superiority to the legacy standard of care.
Right.
Submitting that final data package is a massive valuation driver.
It is the crown jewel. And while we wait for those U.S. regulatory filings, investors must monitor the actual commercial execution abroad.
Show me the money, basically.
Exactly. We need to keep a close eye on the upcoming quarterly earnings to see the initial revenue streams actually coming online from those launches in Macau and Saudi Arabia. The narrative is great, but the proof will be in the actual cash flow.
So, synthesizing all of this for you, the listener, it really is the ultimate biotech binary event.
It really is.
If you enter this trade, you are betting that you are perfectly timing a buy-the-dip mispricing, getting in at a discount while retail traders are panicked over a marketing letter.
Right.
But the dark side of the coin is that if management fumbles that 15-day FTA response, or they run out of money before those global sales ramp up, you are left holding a cash-burning bag facing imminent dilution.
That is the unvarnished reality of the trade. It requires high conviction, a tolerance for volatility, and strict adherence to the timeline.
Which brings us to the final score and verdict. Based on all the data we've unpacked today, what are we looking at?
Based on the structural integrity of the long-term uptrend, the proven statistical power of the Quilt trial, and the brilliant utilization of reliance-based global expansion, the final score sits at an 8 out of 10 bullish rating.
Okay, an 8 out of 10.
However, this must be framed strictly as an aggressive swing trade for the next 3 to 6 months.
So don't fall in love with it.
No, this is not a set-it-and-forget-it retirement hold. This is about capturing the technical recovery from the FDA headline overreaction and riding the momentum into those upcoming BLA submissions.
An 8 out of 10 bullish. An aggressive 3 to 6 month swing trade. It all comes down to the core wealth-building takeaway for this entire sector.
Which is?
High-growth biotech investing absolutely requires the ability to separate operational headlines from clinical fundamentals.
100%.
A marketing violation is a headache, but a failed clinical trial is a disaster. Knowing the difference between the two is exactly where the smart money finds its edge and its entry points. Thank you for walking through this minefield with us today.
It's always a fascinating landscape to navigate, especially when the technicals and fundamentals temporarily decouple like this.
They really do create the best opportunities. And before we go, I want to leave you with a broader question to ponder. Something that extends way beyond just Immunitybio and touches your entire portfolio.
I like the sound of that.
We talked extensively about how they are using reliance-based reviews to get fast pass approvals in Macau and Saudi Arabia.
We did.
So think about this. If a biotech company can leverage these global pathways to secure world-first approvals and start generating real massive revenue in international markets before fully conquering the slow, bureaucratic U.S. system,
Right.
does the traditional FDA-centric playbook for how we value biotech companies need to be completely rewritten?
Oh, that raises a profound question about the future of the industry itself.
Yeah.
The balance of power might really be shifting globally.
It really might. Because maybe the X-ray machine we've been using to evaluate these companies, that binary US-only lens, is finally starting to break. Keep an eye on the charts. Watch that 15-day FDA response deadline like a hawk, and we'll see how this defensive grid powers up from here.